Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage, I tell.
All right. Hey guys, it's Mark Itel here, and you are listening to the Mr. Mortgage Show. And friends, thank you so much for choosing to spend a bit of your day with us today. We have an awesome show lined up for you. We are going to deep dive the data, and man, oh man, there was a lot of data this week, including the Federal Reserve meeting and their comments on the policy, most specifically interest rates, right? Everybody wants to know what's going on with interest rates. Well, guys, I've said it 100 times, interest rates not the most important number in the transaction, but nonetheless, we're going to talk about it. I don't think it was a surprise to anybody who listens to the show. We've been beating this drum for months and months and months that the Fed is not ready to start cutting rates yet, and they've said it on so many occasions, yet every time they have a neutral stance, suddenly the market thinks cuts must be coming, and last month was really chaotic. You know, there were people forecasting 5 cuts of a quarter point each in 2024, which, in my humble opinion, would not have done a whole lot to mortgage rates. And we'll talk about that in a minute. And I know that's a controversial thing to say, but guys, the Fed funds rate does not directly impact mortgage rates, although they do have a tendency to move together. And well, here's what I mean by that. Let me just get this off my chest and we can move past Fed talk. I do want to share some wins this week because I think the magic is in finding the opportunity in the data that's in front of you today and not waiting for some, big euphoric symbol to appear in the sky to indicate it's time to make a decision. So many people are walking around singing that old Rolling Stones song in their head. I'm not waiting on a lady. I'm just waiting on the Fed. I'm just waiting on the Fed. Well, the Fed's not going to do it for you guys. And here's what I mean by that. Last year, the beginning of 2023, the Fed funds rate was 1 full percentage point lower than it is at the beginning of 2024. Yet, the mortgage rates at the beginning of 2024 were almost the same as the beginning of 2023. Well, wait a minute. How is that, Mark? If everybody's running around out there telling me that once the Fed starts to cut the overnight rate, mortgage rates have to fall, that doesn't make any sense, does it? Well, no, it doesn't make any sense because the two don't directly impact one another. And I wanted to share that. Let's get that out of the way. The Fed could start lowering rates. And yes, it's likely that the credit markets in general will move together, but it doesn't directly impact mortgage rates, nor is it a 1 point for 1 point correlation. So I just wanted to get that off my chest because that's been driving me crazy as I see people kind of spin this information to encourage somebody to get off the fence. And if you need that much encouragement to make a decision, it's probably not the right time, guys. You should probably use these core principles when deciding whether to buy, especially your primary residence. I think the number one thing I would look at, first time buyer or not, I would look at these core principles. Can I comfortably make the down payment? Whatever that down payment is, 3.5%, 5%, 10%, whatever you desire to put down, do you have that money saved? And can you invest that money in the home and not miss it? I can't tell you how many times we go through the application process with somebody and they have just enough money to make this happen. Now, if they're prepared, that's not a big deal. If they've got some additional funds coming in, maybe they're going to get a big bonus. Maybe they're about to pay off the car. If they've got a plan, that's not always a bad thing. But oftentimes they saved up just enough to make it happen, and they're not comfortable putting that down on a property. And in those instances, maybe putting a little bit less down on a smaller property might be the way to go. But that's one of the pillars I would look at. Can I comfortably make that down payment? The next thing is the budget amount, right? Because in some markets, it's cheaper to rent each month than it is to buy. So you have to really look at that number. What am I going to spend each month? Now, rents are likely to go up historically, although in some markets they've pulled back, but that was after a blazing hot run of increases year over year throughout this COVID cycle that we've been in. But nonetheless, historically, rents have a tendency to increase. So you can look at that and say, okay, can I comfortably make the payment? Can I comfortably make the down payment? And then that payment includes so many things. It includes your principal, your interest, your taxes, your insurance. And those are the big wild cards right now, the taxes and the insurance, because so many people pull up the tax records and say, well, the taxes on Mrs. Johnson's home are $1,800 a year. Well, that's because Mrs. Johnson bought that home, 22 years ago and filed homestead exemption. And in Florida, under the Save Our Homes Act, it's capped at a certain maximum increase each year. So her taxes are under market because she's been protected by the cap for increases. Guess what, guys? Once she sells that house to you, that resets at market value. So your taxes are going to go up. Insurance right now is a big, big wild card. I would definitely, if you're out there house hunting, make sure you have a recent and accurate insurance quote, because that number is getting big. We're talking to people all the time who are calling us saying, hey, can you give us an insurance review? We've got that service, Homeowners Insurance HOI Policy Review. .com is the name of the website, but we've partnered with some insurance brokerages to try to give our listeners an outlet to get an easy comparison quote on their policies. So those are the things I would look at. Monthly payment, make sure you're factoring in real numbers in that monthly budget, because there's nothing you're going to be able to do about it. Next year, when those property values reset and the taxes adjust, or annually when you get that renewal letter from your insurance company saying, hey, your policy premium increased. In Florida in particular, there are no caps on premium increases. Now, some of the insurance companies have to go before the insurance commission and get their increases approved, but they're approving 50% rate hikes in some instances. So do you have the money? Can you live comfortably without that deposit in your savings account anymore? A lot of people think I'm going to put that money down and go get an equity line and take that money right back out. There's so much information bouncing around on the internet about house hacking and real estate hacking and equity hacking. Heck, I was scrolling through social media the other day and I saw a tutorial on turn your equity into a bank. And this person was encouraging people to take an equity line and then use the funds from that equity line to loan to other people to start small businesses. Somebody might need a, pickup truck or a trailer to start a little handyman service or whatever that's nuts, guys. That's nuts. And they had this beautiful calculation how, if you're paying 8% in your equity line, but you're charging 12% in interest, you're making 4% on your money, plus your house. All of that sounds great in theory, but in theory can get you tripped up in a big, big way and in a big, big hurry. Guys, there's so much information running around out there. It's like a buffet. We've all been to a buffet, whether we'll admit it or not. At one time in our lives, we were at a buffet and we walked in and we said, oh my God, look at all this food. It looks beautiful. There's so much of it. But on closer inspection, it's really not that beautiful. And after tasting a bit of it, it's not really that good. And that's how I feel about a lot of the advice that's running around out there right now. Is it a good time to buy? Yes, isn't always the answer. Is it a good time to sell? Yes, isn't always the answer. Should I refinance and pay off all my debts? Yes, is not always the answer. We're in a jam. Should we do a reverse mortgage? Yes, is not always the answer. Should we listen to the Mr. Mortgage Radio Show and call or text in our questions when we're curious about these things? Yes. The answer to that question is always yes. Hey guys, you hear the music? You know what that means? That is my cue. We'll be back in a few. Sit tight on the other side of this short break. We'll be back with more of the Mr. Mortgage Show. Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and this is the Mr. Mortgage Show. Guys, you heard the man. If you have questions or comments and you want them on the air, just call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. And Jen is womanning the hotline, and she will get your questions on the air. If you're shy and afraid to dial or prefer not to text, just head over to MrMortgageRadio.com. That's MrMortgageRadio.com. There's a big orange button. You can't miss it. It's right in the middle of the screen. Just click that button, follow the instructions, and Jen will read your questions on the air. And speaking of Jen, I know we've already gotten some questions back there. She's just finishing up a call, so I'm going to ramble for a minute, but I was hoping she was going to keep me off my soapbox because I wanted to open the show with a couple of wins from this week, because you hear me say it all the time about finding the opportunity in every market. And some people are blaming interest rate and housing prices as obstacles. And they are, guys. There's definitely no doubt that it's more challenging now than it has been in the last, 3 or 4 years. But with that being said, people are still finding workarounds and making some significant changes in their life with financing, refinancing, equity. And if we have time this week, I wanted to share a few stories with you. I don't want to spend any more time away from your questions because I know we've got some ready. Jen's off the phone now, so I'm going to throw it to her and see if we can't get some questions on the air. Go ahead, Jen, when you're ready.
Carmen sent us this. I have an approval from my bank for $205,000. I found a great condo for $200,000, but my realtor says if I go with a condo, my buying power is lower. Does this make sense? Can you help me understand?
I think I understand. It's not that I'm trying to figure out the easiest way to answer this. It's not that your buying power is reduced from a monthly payment standpoint. What I think is happening is I think the homeowners association in the condo, that fee, that monthly number is large enough that it's pushing the purchase price to keep the payment the same down. So in every monthly payment, from a mortgage standpoint, there's principal, interest, property taxes, and homeowners insurance. Those are the four things that when we're doing a debt to income calculation for the monthly mortgage payment, whether you escrow or not, those four numbers are always in there. And if you're putting less than 20% down, private mortgage insurance is in there too. So there's 5 numbers that make up that monthly payment. Now, if you add to that homeowners association dues, that's a 6th number. Now, the only thing that doesn't change is the total. So if there's a big association, you're going to have to lower the loan amount to lower the principal and interest. Does that make sense? So if you're approved for, let's use round numbers. If you're approved for $2,000 a month, and that equated to a $205,000 loan amount at whatever interest rate you were approved for, and let's say principal and interest were, again, keeping round numbers, $1,800 a month, and property taxes were $100, and insurance was $100. That's $2,000. And let's say there's no mortgage insurance because I just spent your whole $2,000. Well, if suddenly there's another $200 a month that's required in association dues, that $1,800, the principal and interest, needs to be lowered to $1,600 to keep that number, that top line number, the same. So I hope that makes sense. I'm almost positive that's what your agent is talking about, is that the association costs are going to pull that number down. Because if you're buying a single family home, right, a freestanding property, not connected, not a townhouse, just by itself on a lot, and there's no association, you're going to have just principal, interest, taxes, and insurance. There's no association on that. You're going to have more buying power. So maybe she did frame it, or he framed it correctly from a dollar standpoint to keep that monthly payment the same. I hope that makes sense and I didn't confuse you. But guys, that's why I say interest rate doesn't matter. Housing price doesn't matter. The monthly payment is what you're qualified for. Now, at a 2% interest rate, that monthly payment buys a lot more money than at an 8% interest rate. So you're qualified for a bigger house, but it's confusing because your mortgage company is looking only at your monthly payment. You are qualified for a percentage of your income to be allocated for the mortgage payment. The lower the rate, the more money you can buy, but that monthly payment never changes. Whether the interest rates are 2% or the interest rates are 10%, the payment you're qualified for never changes. The loan amount may because of the interest rate, but the payment doesn't. The only way to move that needle up is to earn more income. So I know it gets super, super confusing. There are so many factors that go into a monthly payment that assessments are another thing with a condo. Sometimes you're having to buy in and fund an assessment if the seller can't pay the assessment. So lots of things to be aware of when purchasing a condo, and the association dues vary wildly. I've seen $30 a year association dues, and I've seen $2,000 a month association dues. So they can vary wildly. And I'm guessing that's what your agent is talking about. But if you want to deep dive it and you need some help understanding it, just call me off the air and I'll walk you through the numbers. But great question. I appreciate it. Hey, Jen, do you have another question ready? Okay, go ahead.
Nelson has this question. I'm really hesitant about buying right now. I keep hearing rates are coming down a lot this year. But will prices really jump if rates come down? I know it's a catch-22.
Hey, Nelson, this is the magic, the $64,000 question or $1 million, whatever it is. It's nobody knows. Everybody thought interest rates were going to kill the housing values. Didn't happen. Property values are gone. What did we say in the opening segment? We're up 5.1% year over year in the face of 8% interest rates twice. So here's the thing. I think that taxes and insurance are putting so much pressure on the monthly payments. You heard me just describe that, right? The monthly payment is the magic number. That as taxes and insurance eat up more of that monthly payment, there's less room for principal and interest. So I think interest rates would have to pull back considerably. Into the fours before we see a boom sparked by interest rates. That's my personal feeling on it. If that happens, then all of the people who have a load of equity can sell and move up or down and use that equity to put a big down payment down on the new higher priced house. But unless rates get way back down there, which I'm not convinced is going to happen, I don't think we're going to see, and I know I'm an outlier. I'm one of the dissenting voices in this realm. I don't think interest rates alone are going to move enough this year to suddenly push housing prices through the roof just because of increased demand. I just think there's got to be more incentive for the seller to participate. And that's what I mean when I just don't think that rates are going to move enough to make that happen. So if you're ready, now may be the time. But if you're that on the fence about it, it may not be the right time. And look at those things I talked about in the opening segment: down payment and monthly payment. Those are the deciding factors. So those should be the guiding principles. Hey guys, you hear the music? You know what that means? That is my cue. We'll be back in a few. Sit tight on the other side of this short break. We'll be back with more of the Mr. Mortgage Show.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we're back. My name is Mark Eitel, and you are locked and loaded with the Mr. Mortgage Show. Guys, thanks for hanging out with us today. We are having a blast. We covered some data, we're answering some questions, and we're going to keep this thing rolling. Guys, if you have questions or comments, just call or text 855-462-7292. That's 855-462-7292. That is the Anytime hotline. And Jen womans the hotline, and she will get your questions on the air. Again, that number is 855-462-7292. Or head over to mrmortgageradio.com. That's mrmortgageradio.com. And right in the middle of the page is a big orange button. You can't miss it. It says, get your questions on the air. Click that button, follow the instructions, and Jen will read your question on the air. But guys, we've had some good ones so far. Let's keep them rolling. Jen, are you ready back there? All right, fire away.
Here's one from Carlos. I'm talking to my parents about a reverse mortgage. I know it will really help them, but they think this will prevent them from leaving the house to me when they die. Is this true?
Hey, Carlos, this is a great question, my man. I really, really appreciate this one. That is one of the biggest common misconceptions around the reverse mortgage. So I want to touch on a couple things here, but let me start by answering your question. No, it will not prevent them from leaving you the property when they pass. Now, when you inherit the property, there'll be a lien on it like any other mortgage lien. You can pay that lien off and keep the property. You can refinance it into your name, or you can sell it and then just pocket the equity. So huge misconception around the reverse mortgage. A lot of people think they sign their house over to the bank and the bank then lets them live in it until they die. And then the bank takes the property and the kids get nothing. That's not the case. So your parents will not be prohibited from leaving you the property when they pass just because of the reverse mortgage. So I really want to hit that one home because that's a big misconception. And I want to congratulate you on being proactive. I can't tell you how many times it's the children who stand in the way of the parents because they don't want any encumbrances on that equity. They want their parents to spend every other penny before they touch that equity because they're being greedy. They want as much inheritance as possible, forgetting that it's their parents' equity. Their parents made the hard decisions. Their parents made the monthly payments. Their parents did the right things to build that equity up. And then suddenly the kids are, clamoring for them to figure out a way to sell the car and start Ubering instead of, taking the reverse mortgage. Now, having said that, the reverse mortgage is not always the answer. It's not right for everybody. I say it all the time. It's just a tool. A hammer is a tool, right? I use this analogy all the time because I think it's pretty clear. A hammer is a tool, and a hammer can be used to build a house, and a hammer can be used to tear a house down, the very same tool. And it depends on your intent and your skill and the knowledge that you have and how to use the tool. One of the good things about the quote unquote new reverse mortgage, because there were significant rule changes, the product was wildly abused in the past and people did get hurt, but a lot of the new rule changes were designed to prevent that. One of which is a full counseling required so that the borrower, in this case your parents, have a complete understanding of what they're getting themselves into. And it's an unbiased third-party counseling service. It's not the lender. Has nothing to do with, it's a third-party approved counseling service that they have to go through. And they get a certificate at the end of the counseling, and then they're eligible to start the application process. So I wanted to throw that in there because it's very different. But here's the thing. Here's a place I want to congratulate you. A lot of times the parents are hesitant to take a reverse mortgage because they want to leave their kids as much equity as possible, especially the greatest generation, right? The World War II generation. And they're hesitant to put a lien on the property and spend some of that equity because, again, they want to leave as much as, and I think that's awesome. I commend them for what it's wonderful that they want to do that. I mean, even at this stage in life, they're still trying to take care of their kids. That's something to be very proud of and thankful for if these are your folks. But here's the thing. Oftentimes, the children, the adult children, are helping the parents financially anyway. I talked to a couple who are helping to the tune of about $3,000 a month. Well, $3,000 a month is $36,000 a year. And the mother-in-law, the husband's mom, is super hesitant to do this because she's got a nice amount of equity and she wants to leave it all to her son and daughter-in-law. And she's very proud about that. But every year that they live in the circumstances that they're currently living in, the children are spending $36,000 a year to help their folks. So they did the math and said, listen, at this point, we're just going to get a percentage of our money back anyway, Mom. We don't need the money. We don't want the money. We want you to be comfortable living the remainder of your life. And Mom was relieved because she felt more guilt about getting help from the kids than she did about not leaving them the big estate. So I commend you for being willing to have the conversation with your folks. It's not easy, especially when you're the child and you stand to inherit this equity and you're willing to look past that and do the right thing and help your parents make the best decision for themselves. So great question. They will not be prevented from leaving you the property. You'll just have to satisfy the lien, and whatever equities remaining will be yours. So great question, my man. I appreciate that one. Hey, Jen, let's get another question on the air.
Erica sent this question. This may be a dumb question, but I found a house on Zillow, and it says something about FIRPTA. I Googled it, but I'm more confused than ever before. Will this hurt me later when I sell the house?
Hey, Erica, the old FIRPTA question. Great question. I'm surprised that it says that in the listing, though. That's interesting because, and good on you for Googling it. And I understand why it's confusing because the FIRPTA rules, it's federal income tax repayment. I don't remember what it stands for. What FIRPTA is, guys, if a foreign citizen owns a property, and they sell that property, the FIRPTA rule, if you will, requires the title company to hold a percentage of the proceeds back in escrow to make sure the taxes get paid. Because a foreign person is likely going to have taxes due on any profits. And if they're a foreign citizen that has no ties to the U.S. and they just cash that check, Uncle Sam is unlikely to get his money. So FIRPTA was enacted. Maybe that's what it is. Foreign Income Tax something Protection Act. I don't remember. I'll have to look it up. So it has nothing to do with you and it has nothing to do with the property. That's a great question. No, FIRPTA is not going to negatively impact the next transaction. Assuming that you are a U.S. citizen, the property, when you sell it, will be a normal transaction. And if there are taxable proceeds, you'll get them at closing, but you'll be required to file your taxes just as you normally would. So great question. I was going to brag about the big brain on Mr. Mortgage for knowing FIRPTA, but then I couldn't remember what the acronym stands for. So maybe at the break, I'll look it up if I have a second. Guys, you hear the music, you know what that means. That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with FIRPTA and more of the Mr. Mortgage Show. So you think interest rates have gotten too high to refi? Well, not so fast. There are several reasons people refinance. One is to lower their rate, that's for sure. But there are many other reasons. Debt consolidation, unexpected medical bills, home renovation. I even know of one guy who refinanced his house so he could buy his mistress a condo. But let's get back to debt consolidation for a minute. I'm working with a client now. His name is Ben. He's in Palm City. And Ben is going to refinance, pull some cash out, pay off 2 truck payments, as well as a host of credit cards. He's going to use a loan program called the REC Refi to reduce, eliminate, and consolidate his debt. So yes, his mortgage interest rate is going to go up a bit, but he's going to reduce his monthly expenses significantly. So if you'd like to learn more, you can find us online at Mr. Mortgage Radio. That's MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And we appreciate your company and your participation. If you have questions or comments, just call or text 855-462-7292. That's the Anytime hotline, 855-462-7292. And as always, Jen is womanning the hotline, and she'll get your questions on the air. If you prefer, you can head over to MrMortgageRadio.com. That's MrMortgageRadio.com. Right in the middle of the page is a big orange button that says Get Your Questions on the Air. Click that button, follow the instructions, and Jen will read your question on the air for you. All right, guys, I am going to throw it right back to her and keep this rolling. We've had some great questions so far. Go ahead, Jen.
Billy emailed this one. I'm looking at a 2015 double wide on 2 acres. Is it possible to get a normal mortgage on a mobile home? It's not in a trailer park.
Hey, Billy, this is a great question, my man. Yes, you can get a variety of loan programs. So there was a little bit of confusion because during COVID, there were some restrictions, not guideline changes, but temporary overlays, which are just what they sound like. They're more restrictive temporary policy changes. And I don't know why, but for some reason, mobile homes fell into that category. So for a minute there, it was a challenge to get a traditional mortgage on, especially single wides. But anyway, USDA, if it's in the rural area, and there's an easy way to look that up on the map, VA, conventional, and FHA all provide normal 30-year mortgages, what you would consider a quote-unquote traditional mortgage on a manufactured home. Now, here's the caveat. It's technically June of 1976. I prefer to say 1977. It's just easier. Or newer. If it's newer than 1977, all those mortgage programs are available if you own the dirt and it meets all of the other requirements. So I would encourage you to explore it because there are a variety of mortgage programs available. Here's the exciting thing. There are now mortgage programs available for older units. And that was a big challenge in buying older manufactured homes in the past, was that prior to that 1976 date, June 1st, 1976, there was no financing available. Well, that's changed. It's not a quote-unquote conventional loan. It's what's called non-QM, but there are lenders that will do those loans. So great question. The answer is an easy one. Yes, sir, there are programs available. Hey, Jen, let's keep them rolling.
Joanna has this question. I've listened to your show for a year or so and heard you talking about a mortgage for people who have enough to pay cash but prefer to finance. Can you explain how this works? I'll be getting a sizable divorce settlement next month, and then I have 6 months to find a new house. Good job, Joanna.
Good job indeed, right? Jen, you caught me off guard with that. Yeah, so that's a great question. And it's the perfect loan program for this scenario. There's two. One is called asset depletion. And you take the assets and divide them by 84. And that number is what's considered your annual income to use for qualifying you for the mortgage payment. So asset depletion income calculation is what's used in these scenarios. There's another loan program, and the underwriting is pretty basic. If you have the credit and you meet all the requirements, if you've got enough to pay cash, they'll loan you a certain percentage of it. But most of the time when I get this question, we're talking about that asset depletion model. The most aggressive asset depletion models out there will let you divide that total sum by 60 months. Most by 84, and then the most conservative ones are for the loan term, either 180 or 360. But the answer is the asset depletion loan, and it's an easy calculation. But I hope that helps. If you want to talk it through off the air, just give me a call. I'll walk you through the calculations, and we can do it specific to your scenario. So great question. Thank you so much for that one. Hey, Jen, throw me another one.
Chad sent this. I've heard people say the reverse mortgages can lead to foreclosure because the loan balance keeps growing. But is that really how it works? Can we go into foreclosure with a reverse mortgage?
Hey, Chad, another great reverse mortgage question and another misconception. So, no, you can't go into foreclosure if your loan balance exceeds your property value. One of the very cool features of the reverse mortgage is it's non-recourse in that sense. So if property values plummeted or you outlive the projections and the balance grows to a point that it's now more than the property value, that's fine. You can continue to stay there. Foreclosure can't be enacted based on that value to loan balance equation. Now, to answer the other question, yes, you can be foreclosed on with a reverse mortgage. Now, it's not for not making monthly payments because no monthly payment is required. That one big payment is due at the end. And it's not for the loan balance growing more than the value of the property. A foreclosure in the reverse mortgage world would come from not paying the property taxes, perhaps not adequately maintaining the property, and not keeping adequate homeowner's insurance on the property. So taxes and insurance and maintenance are still required to be upkept from a monthly payment standpoint with a reverse mortgage. And that's on you to pay that because you're not making a monthly payment that has taxes and insurance escrowed. So just know that, because a lot of people out there, especially on social media, you see the videos popping up, you'll never make another mortgage payment. Well, that's not really true. You make one big payment at the end. You don't have to make monthly payments, but you do have to pay your taxes and you do have to pay your insurance and you have to keep the property maintained. You can't have a bunch of code enforcement violations and a leaky roof. So, Chad, great question. I appreciate it. I welcome the opportunity to talk to you more about it off the air. Should you wish, just give us a call if you need any more information about that. Appreciate that one. Hey, Jen, do you have another one? Okay, go ahead.
Leanne sent us this. I have a basic understanding of a 1031 exchange when selling. But can we sell an apartment building and buy an office building? The question is, can we go from residential to commercial?
Yeah, this is an easy question. You can do that. You can go from residential to commercial. So great question. And guys, if you're out there and you're curious what a 1031 exchange is, it's a tax deferment strategy. So if you buy a fourplex and you sell it and you've got a lot of profit in it, right? It's worth a lot more now. You can escrow the proceeds. You have a certain amount of time to identify a new property and close on it, and then use those proceeds to buy the new property. And a lot of people will use the 1031 exchange strategy to keep moving up bigger properties up the property ladder. So if you bought a property with 20% down and you owned it for 10 years and now you have 50% equity, so you've got a nice chunk of money, and you take that 50% and you put it down on a piece of property. It might only represent 15 or 20% down on the new property, but it's a larger property, larger loan amount. And then you 1031 exchange that when you sell it into another property. You're basically buying the cash flow and deferring the taxes until the ends. But great question. I appreciate that one. Hey, Jen, let's try to get another one in.
This one is from Brian. I received a loan quote from an online lender, and I'm very confused by all the fees. The rate seems okay, but I didn't expect all the other costs. What should I be looking for to know if I'm getting a fair deal?
Hey, Brian, that's a great question. I hear the music, so I'm going to try to make this quick. And we did change the name to online lender because I want to stay out of court and not use their name on the air. But anyway, look at the origination points. What are you paying? How much are you being charged? And does it correlate to that interest rate? Because sometimes paying 2 or 3 or 4 points to get that vanity rate just doesn't make sense mathematically. And guys, a point is 1 full % of the loan amount. So those fees add up in a hurry. But we have the loan review, fee sheet review service for all the listeners. Guys, go to MrMortgageRadio.com and check out fee sheet review. I'll be happy to walk through those numbers with you. So great question. I'm sorry we're running out of time though. Guys, you hear the music? You know what that means? We have wrapped up another week of the Mr. Mortgage Show. Man, oh man, where does time go? We always have so much fun with you on the air. If you need us when we're not on the air, head over to MrMortgageRadio.com. That's MrMortgageRadio.com. Hey, one more time for the kids in the back, MrMortgageRadio.com. All right, guys, Jen and I will be back next week here, same time, same station.